for biases and estimates, but there's a lot of variance in our knowledge of exactly what's in the tax gap today. But perhaps $60 billion of it comes from corporate taxes, and at least another 50 billion, I've seen numbers as high as 150 billion, is associated in some way or another with pass-through income. If anybody has more up-to-date numbers on that, feel free to share them with me. And there's been some talk that it may reach $1 trillion now when you account for kind of new assets or new players in the field like cryptocurrency and things like that. So we think that one of the key challenges among many that make it hard for the government to narrow the tax gap is simply that the environment is continuously changing. So both in terms clearly of the tax code itself and of the strategies that taxpayers implement from year to year, which have become increasingly sophisticated, especially in certain populations. So the point is that normally we try and approach this with data analysis. So many people here today, Matt was just talking about an approach, have been working on innovative ways of using analytics to grapple with this problem and to develop new audit filters and the like. But data collection is a slow process. So what we'd really like to have are other complementary ways of using our knowledge about the tax system to anticipate changes in the ecosystem, ideally earlier than we currently do. So our work is pursuing the hypothesis that simulation is a powerful way to tackle this problem. So we've been building on some proof of concept research at that MITRE did a few years ago in collaboration with MIT that suggests that this may be a promising approach. So we're trying to move that kind of from academic up to a higher technology readiness level so that we can get this into practice. All right, so broadly speaking, we can characterize making rampant generalizations, the current data-driven approach as reactive in the sense that the government's response to changes in the tax code doesn't really get started until well after a change occurs. So in general, as soon as a change is announced to the tax code, taxpayers, taxpaying entities can immediately begin planning strategies to minimize their liability, as they should. But only after at least a couple of annual cycles does data start to accrue in sufficient volume on the government side that it can be used to research filters and to develop an audit response. So, for example, here on the right side of this slide, say that we're concerned about offshore profit sharing and base erosion. So in 2017, the TCJA introduced a major change here in the form of BEAT, the base erosion anti-abuse tax. And from that moment on, taxpayers have had a chance to respond. So, for example, they might change the way that they categorize offshore payments so that they are less visible, or so they appear to be something that is not covered by the new anti-abuse tax. So in the meantime, the IRS has yet to develop a filter to specifically address compliance with BEAT. So taxpayers are able to exploit this time lag in the government's ability to respond. So we're working to change this picture. We're pursuing what we conceive of as a proactive approach, where we have a simulation that can automatically discover possible taxpayer actions. And then by analyzing the hypothetical decision space or spaces that come out of these models, we can in principle start responding immediately. And that's the key idea, is that if we can anticipate taxpayer behavior earlier, then we can close this time lag in audit campaign development. So, but why simulation? Well, so simulation in my mind is, when it really comes down to it, it's a way of combining causal knowledge that comes from human experts with algorithms and computation that help us understand what the outcomes of different decisions lead to. Or it's one of the possible formal approaches to doing that. So if we understand the cause behind something, then we need less data to understand and respond to it in a particular case, is what it comes down to. Now, the pitfall of simulation, and this is a big focus of our talk here today, is that it can take a lot of R&D effort to create a successful model of a particular real-world scenario that you want to simulate. And once you have the results, may not be generalizable. A model may be somewhat brittle in that sense. So we've seen a lot of simulation work that kind of gets stuck on this point. You assemble a great team to build an intricate simulation, but what about the next question that someone has? And what about the year after that when the environment changes? So the software side of this can be cumbersome. So our work has focused for the last year or two on building a light and reusable framework that can be used to answer simulation questions specifically about tax systems with some agility. And the core of our approach is an evolutionary algorithm for doing behavior discovery in these spaces. It's a search or optimization process. And I'll talk more about that in a minute. All right, so number one, we got a couple of research objectives here. Number one, at this kind of preliminary phase of this research, we want to validate our methodology on the left-hand side of this slide here by showing that it has this extensibility perspective, the sort of thing that a software engineer would look for. We want to have a framework where we can rapidly put together new simulations of different parts of the code or tax system without rethinking our entire approach every time from the ground up, right? So we've accomplished this by building a modular framework of atomic components, which is generally what you look for in software regardless. And then to validate it by using that that framework to model a suite of tax policy scenarios that were introduced by the TCJA in 2017. Okay, so that's the modeling framework. On the other side of the slide, we're talking just as importantly about the fact that we need, once you have a simulation, you need a way to explore the decision spaces that a simulation opens up. That's often the point of a simulation project in any field, is to explore a decision space. So what actions and strategies are available to taxpaying entities under different assumptions about their profits, their assets, and about the tax code itself. And that's where evolutionary algorithms come into play as our methodology for discovering behaviors. So our overarching hypothesis is that if we can understand the space of taxpayer strategies that are out there better for recent changes in the tax code, then this framework will help LB&I in particular be in a better position to approach audit filter campaign development. All right, so I'm going to talk through an example here somewhat quickly. We've been validating this on a few different scenarios to build out. But I'm going to dive into that base erosion example. So this is a tax org chart representation of what's going on in our simulation scenario. So this scenario kind of demonstrates how complexity can start to add up real quick when you start trying to model real world strategies. So let's say we want to answer questions about base erosion and profit shifting. So this is a multinational tax strategy. So we start simple. We start with the domestic corporation right here in the center, which is our focus entity. Then it needs some source of profit. So we've chosen to model kind of the mechanics of where revenue comes from to give the model more flexibility. This, of course, is a judgment call with any simulation modeling work, is how far down the rabbit hole do you go in terms of fidelity versus keeping things abstract enough to be lightweight. But we do have a generic market object that our entities can trade with under constraints that are scenario specific. So here we're trading consumer goods that we can sell to the market, and we can buy raw materials. And what we're trying, so this little engine here with the bank on the left that also allows the entity to secure loans and to make loan payments back is kind of the heart of most of our scenarios, because it provides a source of gross receipts, so there is something to tax, right? And then we build up in complexity from here. So there's a few different things we could add here depending on the scenario. We could add partnerships if we wanted to study pass-throughs, but for BEAT, we want to look at a foreign corporation, so we have that multinational aspect. And base erosion is all about shifting profits in some fashion overseas or offshore. And here we open up the ability for the domestic corporation to take an action to license an intangible asset from this foreign corporation that there's an ownership relationship with. So the key is that we have that special action that allows the entity to do that licensing, and that can open up an opportunity if it takes the right sequence of actions in the simulation for it to reduce its tax liability in a way that may be considered abusive or circumventing this tax, or at least non-compliant, right? So we feed this kind of scenario description into our simulation engine, and without getting into the nitty-gritty of it, basically we have actions that the entities take in the simulation, and those trickle out to what the tax consequences are, and we explicitly compute like what values go on your form, 1120 and things like that. I'm going to skip ahead here really quick just for time. And now let's talk a bit about the evolution of behavior discovery side. So once you have a simulation like this, what can you do with it? Well, what we do is treat the simulation essentially as a black box. Its purpose is to compute consequences. So we can feed in a plan, meaning a sequence of actions that the entity takes: take out a loan, trade this entity, secure this royalty, trade this asset, I mean. And then what we get out the other end is a score that we define a fitness function in evolutionary algorithms terms that just indicates the quality of the plan in the sense of whatever incentives we want to encode in the system. So we might incentivize the entity to maximize its cash on hand at the end, or to minimize its tax liability, things like that. And kind of the secret here is that if you can take inputs and compute a score over a function, then you can use search algorithms to search that space to find increasingly good plans. And that's what an evolutionary algorithm does. It's a very general purpose approach to doing that, that is applicable to kind of complex settings like this, where we have lots of moving parts. And when we do this on our beat scenario, we get a plan out that looks like this. The algorithm automatically finds this sequence of actions from top to bottom. And at the very top, the first thing it does is enter into a royalty contract with the foreign corporation. And that allows it to send some money overseas while also benefiting from that intellectual property to reduce its production costs and make additional profit. So this right here is nothing, significantly profound in terms of being able to apply this, as Matt said in the previous talk. We know that examiners are very busy. We're not going to put toy models, in front of them too often. But what we're trying to do here is show that we have a way with this tool of discovering sequences of actions that a rational but risk-tolerant actor might be likely to take. And if we can prove that this can find things that we would expect in collaboration with experts, like, well, if you do this, that, and the other, then it'll benefit you, then our next phase of this research for future work is going to look at building much larger simulations. What if you add aggregate entities, brother-sister groups of 5 partnerships involved in various structures, kind of the more complex networks and multi-tier things that Matt was illustrating on the previous talk. And in those cases, then the next stage would be, can this methodology discover potential decisions that maybe human experts hadn't foreseen, hadn't realized there was this loophole or things of that sort. So that's where we're going next. And I think I'm just about arriving at time now. So one thing I did want to highlight is just to circle back and hit the point of how this approach differs from data analysis. So nothing I've described involves data analysis. We are doing data analysis as part of this project to look to understand different aspects of the client base, and to kind of test hypotheses about how we think the real world works, and then that affects how we implement simulation. But this is really a method that should be complementary to data, because as the whole point is, it may, if successful, if we raise this to the point of being practically useful rather than useful only on toy demonstrations, then it could be something that could allow us to preempt things that may not turn up in the data for another couple of years and things of that sort. All right, and that's it for this topic. Thank you very much. Oops, looks like you got all of our backup slides. All right, there you go.
All right. Again, I'm Alan Plumley. Pleased to present this joint research with my colleagues, Daniel Rodriguez from the IRS, RAS, and Lee Nickel from the MITRE Corporation. This is making use of some estimates of the indirect effects that we presented at this conference a couple of years ago. And the point here is, how do you actually make use of estimates like this in an operational context of allocating resources? So to start, I wanted to kind of lay the groundwork here of resource allocation with a very simple little illustration. This is a typical plot of actual data from correspondence audits, where we plot the cumulative direct revenue against the cumulative cost of conducting those audits, where the revenue is the direct tax revenue, which is the additional tax paid by the audited taxpayer for that year. And the cost is the full life cycle cost of the examination, any appeals or counsel activity, and then collection activity as well. And what we do is we sort all of the audits in declining order of their priority. And so, as we saw from the first session, operational audits are risk-based typically. They are not chosen randomly from the population. So this is an attempt to show, as they actually are allocated or selected operationally, how the results play out. And so we can fit a curve through the raw data there. And once we've done that, we can actually get rid of the raw data and manipulate the curve. And so at any point on that curve, let's say point A, the average revenue to cost is merely total revenue divided by total cost at that point. And that, of course, changes as your budget, your cumulative cost, increases or decreases. And so it declines with increasing budget. But from a resource allocation perspective, what we're interested in is the marginal revenue to cost. So that's the, that tells us at any given point along the curve how much additional or less revenue to expect if one more or less dollar of budget were allocated to that category. And like the average revenue to cost, it declines as we do more audits. And so ideally, as is the case in this category of audits, the high priority cases have high marginal revenue to cost, whereas the lower priority ones on the right have the lower revenue to cost ratio. Well, you can convert that same chart by plotting the slopes, that is the marginal revenue to cost, as a function of the cumulative cost. And for that very same audit category, this is what we get. Well, you could very easily then superimpose that same relationship that exists in other audit categories. And I've restricted it to 5 so it doesn't get too complicated here for illustration purposes. But it's basically the same process. And so the question would be something like this. How could, or how should we allocate, let's say, $5 million of budget across these 5 categories? Assuming that our $5 million budget is really the only thing that constrains us. We'll come back to that in a minute. Well, revenue is maximized when all the budget is allocated. We make the most use of what we have. And a condition of the optimal result is that the marginal revenue to cost ratio is equalized across all unconstrained categories. Now, if that were not true, then additional revenue could be achieved by shifting resources around from categories with lower marginal revenue to cost to the category with the highest marginal revenue to cost. And you keep equalizing until they are indeed all equal, except any that happen to be constrained otherwise. Well, in our case, I've shown in the horizontal gray line here, the marginal revenue to cost ratio that if it's applied to all 5 of the categories, fully uses the budget and achieves the highest overall revenue. And so where that horizontal line intersects a given category indicates what the allocation should be to that category. And I've summarized the results here, and we get a total of $126 million of revenue for that $5 million budget. Fairly straightforward. Well, the question, though, here in this presentation is, how do we incorporate indirect effects? And actually, before answering that question, I want to answer the question, why would we want to do that? And I go back, actually, to this morning's session, where I commented on one of the papers and suggested that because IRS does have a budget constraint, and because the costs of audits vary widely across these various categories, the way to maximize revenue is to allocate according to the marginal revenue to cost. And the presenter pushed back a little bit and said, well, yeah, but you got to be careful there, because if there's a high cost category, the taxpayers there may be emboldened to be more non-compliant because we're not going to go after them as much. And indeed, that is the concern. That's why we need to incorporate indirect effects. These indirect effects are the behavioral response to whatever level of auditing presence we have in a given category. And so in a prior study, we estimated the average specific indirect effect for a variety of correspondence audit categories. The specific indirect effect is the subsequent change in reporting behavior of taxpayers who have experienced an enforcement activity. I'll get to another category of indirect effects in a little bit. But anyway, we've updated those estimates and added to them. And so for our 5 categories that are actual categories, here's our indirect effect revenue predictions. And we have corresponding average cost estimates, which gives us then an average indirect revenue to cost for each of those categories. So how do we make use of that? Well, if we go back to our diagram here and actually expand the y-axis a bit to include up to 70 in this illustration, then we can include the indirect effects very simply. Because the indirect effects, we've estimated our average effect for all the cases within a given category, then adding the indirect effect to this direct effect merely shifts the direct effect curve upwards. Now, each curve is going to shift a different amount because the indirect effect, as we estimated it, is in fact different across these audit categories. So if we do that, these curves shift up varying amounts depending on the specific indirect effect. And if we apply the same logic, we can find the optimal marginal revenue to cost ratio that makes use of both the direct and the indirect curve, and that produces a corresponding set of estimates of the combined direct and indirect revenue. Okay, so you can summarize that by looking at each category, A, B, C, D, and E. What would be the outcome if you're optimizing on the direct effect only in blue versus the outcome if you optimize on the basis of both direct and indirect revenue in green. So what I've shown here right now is the direct revenue outcome under both of those scenarios, but we also have the indirect effect that would be corresponding to the direct effect there in each of those allocation strategies. And so there's some important takeaways here. One of them is you notice that when you allocate according to the optimal direct and indirect effect combined, the total direct revenue is going to decrease by definition. It will always reduce the total direct revenue because the optimal, if the optimization is optimizing on both direct and indirect, it's not optimizing on direct only, so it's not going to have the maximum direct effect. Another observation, though, is that when you do optimize based on both direct and indirect effect, the optimal solution provides much more, typically much more indirect effect to compensate for the loss of direct effect, so that in this case, there's a net gain of $14 million. Now, this is actually completely analogous to the current practice in exam of imposing minimum coverage constraints, that is, sacrificing some direct revenue in order to promote even greater indirect voluntary compliance revenue. But here we're doing it with empirical estimates of the indirect effects rather than subjective minimum coverage constraints. So it's somewhat familiar territory, but it's a bit more empirical rather than based on assumption. Okay, well, there are some challenges and interesting special cases that we've already come across. One is, what if we estimate the indirect effect and it comes up negative? Well, that would suggest that audited taxpayers become more non-compliant following the audit. And while that conceptually could be true, this ought to be a red flag for us to at least test our analysis carefully. And so that's what we did. We estimated one of these, and there's several things going on that we uncovered that allowed us to conclude that actually there appears to be a small positive rather than a negative. One of the things we had done was combine two categories together because they're somewhat similar. And yet when we broke them apart, we saw that their actual behavior was quite a bit different. And so estimating them separately would make sense. And you can look at things like what is the trend of reporting the focus. These audits are very issue focused. And so what is the trend in those things, both in the test group and the control group? But then also sort of our bottom line metrics. How does total income vary over time and total tax? And as we look at these things and comparing control group and test group and controlling these two different categories that had been combined, we ended up concluding that yes, they are different. They should not be combined. And anyway, that led us to some improvements in our methodology. And so it's always good to check your assumptions. But there's another possibility that we actually encountered, and that is, what if you estimate a huge indirect effect? Well, if that's true, it would shift most of the budget to that category. And so you really need to be sure that that's indeed what the response would be. But if you test it carefully and you say, well, that's what we're seeing in the data, then it may still be reasonable to impose, in this case, a maximum budget constraint rather than a minimum budget constraint, so that it doesn't swamp all the other categories. I'm guessing that with more years of data and more experience here, we'll find that none of the categories swamps the others. But one of the useful things that we encountered here is we saw that, and it made us more sensitive to the possibility. All right, well, I mentioned that this was focused solely on the specific indirect effect, which is the change in behavior of an audited taxpayer following the audit. And that doesn't depend on the number of audits conducted. It's all about that taxpayer and what he or she does in subsequent years. Well, there is a general effect of audits and enforcement in general. And that would be the change in behavior of taxpayers who are not audited, but somehow they're affected by the audits. Their perceptions change, maybe there's networking information that flows. There could be any number of mechanisms that would cause the enforcement action to have a ripple effect on unaudited taxpayers. And it's pretty likely that that kind of effect would depend on the number of audits conducted. So it wouldn't simply move the marginal revenue to cost curve upward by the same amount all along the curve. It would be a nonlinear shift. And it's possible that this general effect could be larger than the specific effect. And so we're in the early stages of revisiting approaches to estimating those general effects. But once we have some, and I'm optimistic that we will eventually, there would be a way similar to what we've had here, but tailored to the nature of the general effect, to include it also in the resource allocation decision-making process. But until that time, we can continue, like exam has been using for ages, minimum coverage constraints. But in this case, they would be not for the purpose of incorporating all kinds of indirect effects, because if we have specific estimates of specific effect, if we have empirical estimates of part of it, we can include those, but then now the minimum coverage constraint would apply only to the general effect piece of it, and that may change in their judgment. Anyway, that's all I wanted to cover, and I look forward to the discussion.
All right. Thank you, Alan, and thank you, Raz and the Tax Policy Center for inviting me to be a discussant for section 3 here. My name is Mike Stobrianos. I'm a principal with ASR Analytics, and I've spent the last 25 years or so of my career working primarily with the Raz organization on a variety of analytic initiatives. So the IRS TPC annual research conference is one of my favorite events of the year. It's right in my wheelhouse, and it's a privilege to be able to offer comments on these 3 really outstanding papers. The approach that is kind of hinted at in the subtitle of this section, thinking inside the box. It's funny, Alex Turk in his comments earlier this morning talked about how economists and econometricians like to come up with catchy titles for their papers. So this session's title certainly fits in that category. Thinking inside the box is a reference to the notion of using computers, using machine learning, the box, to guide thinking. And I think all three of these papers do that in different ways. That the approach of using advanced analytic methods and compute power to guide tax administration is definitely one that is near and dear to my heart, and it's a very hot topic in tax administration today. So in my comments today, I want to offer kind of comments on three different aspects of each paper. First, just a quick recap and a summary of what I saw as some of the key insights from each paper. Then I'll offer a few topics for discussion that perhaps we can discuss during the Q&A session. And then I'll offer what I saw as a couple of future areas of investigation for each of these papers, and we'll take them in turn. But before jumping into the first paper, I wanted to highlight what I saw as a couple of common themes that came out of the three papers. One is that further advances and ongoing advances in the volume of data and the availability of compute power is creating new opportunities for the IRS to use analytics to guide enforcement actions. The second, and this is particularly in the first two papers that were discussed today, is I think there's real opportunities to use human-in-the-loop processes. In other words, to combine the expertise of compliance practitioners at the IRS with the insights that are derived from data to accelerate the learning process. So we'll talk a little bit about that. And then the third is that these methods are enhancing the IRS's ability to detect unknown unknowns, right? To identify types of non-compliance that were previously unobservable or even entirely unknown. So let's jump into the first paper. I'm going to actually go in a different order than they were presented. We'll start with Alan Plumley's paper, the one that he presented, since it's fresh in our memory. So basic premise of this paper is that the audits conducted by the IRS have effects for a couple different reasons. One is the direct effect. If I get audited, I may have to pay additional enforcement revenue. And then there are the indirect effects that if I am audited, I may be more cautious in the future, or I may be more, bold in the future, and that will impact my future tax payments. I may be cautious, and it could have a positive effect on future revenue that I pay voluntarily. And then there's also, that's the specific indirect effect that Alan talked about, and then the general indirect effect that I may complain to all of my friends about the fact that I was audited, and as a result of that, some of them may be more cautious in the future. That would be the general indirect effect. Then the other part of the premise is that if the IRS is acting rationally, and if its goal is to maximize total revenue, it should allocate its resources in a way that maximizes the combination of direct and indirect revenue. It shouldn't focus exclusively on direct revenue. So one insight that I thought Alan offered in his presentation, he touched on this specifically, is that the IRS may have objectives other than maximizing revenue. It may have goals around fairness, equity, taxpayer experience, minimum coverage, and that all of those can be thought of as a way to impose additional constraints on the overarching goal of revenue maximization. I think that's an important kind of fact. It's an important thing to recognize, because it provides a useful construct for how to think about those competing objectives, and it provides a way to quantify the trade-off that is being made. I'll talk a little bit more about that later. The last item here on the summary and key insights is that there's a significant impact here. If we could account for the specific indirect effects, we could increase audit revenue pretty significantly. In the simple example that Alan presented, with a $5 million budget constraint, we could increase total audit revenue by about 6%. And if you extrapolated that to all enforcement revenue, you could be talking about in the neighborhood of $3 billion. So In terms of topics for consideration and discussion, I couldn't resist offering this first one, which it's unfortunate that we have to think of the budget constraint as a fixed amount, because while we could increase enforcement revenue by 6% by optimizing the allocation of audit resources, recognizing indirect effects, if we just allocated another dollar towards enforcement efforts in the simple example that Alan presented, if I'm understanding the data that he showed, we would generate nearly $50. So that's worth a step back, maybe. The second point is that as I said earlier, exam planning is subject to a number of constraints, right? And the methods that are outlined in this paper help the IRS to quantify the impact of those constraints. One thing that I think is worth kind of further discussion is what is the ability and the sort of willingness of the IRS and operational auditors to relax some of those constraints. Some of them may be mandatory constraints that are imposed by regulation. Some of them may be more institutional constraints. Thinking about the ability to modify some of those non-revenue based sort of decision factors, I think is worth consideration here. Alan also talked about the challenges of estimating general indirect effects, but I do think that's a critical area of further research, finding out what the evidence tells us about the relative size of general versus specific indirect effects. I'll offer a couple thoughts about how we might continue to push the envelope in terms of measuring general indirect effects. And then the last item, and this again goes to something that Alan touched on based on the commentary from a previous session, it's interesting to think about how taxpayers might react to changes in the allocation of enforcement resources, and that it might change their behavior with respect to specific indirect effects. So, for example, a substantial increase in the volume of audits in a certain category might make taxpayers in that category even more cautious in response in their behavior in future years. So a couple areas of future investigation. Well, first, the IRS has done a lot of work and continues to do a lot of work looking at the impact of behavioral nudges on compliance outcomes. There's probably some fertile ground here to try to measure the especially general indirect effect of audits through things like laboratory research, through designing enforcement treatments even to try to increase their specific or general indirect effect. And in fact, I know Raz has done studies in the past looking at the design of audit treatments to produce increased indirect effect. Some of those actually are mentioned in the last bullet here. Enforcement treatments that are designed to impact networks of taxpayers could be multiple entities within a tiered partnership structure, could be multiple individuals using the same preparer or existing within the same geographic area. So I think there's some good lessons from the research about the both specific, but also, and maybe more so, general indirect effects associated with those sorts of enforcement treatments. And then last item, this would, I imagine, exponentially increase the complexity of this analysis, but it would be interesting to see how the optimization problem presented here would play out as we bring in additional enforcement activities and consider some dependencies across functions. So if we increase audits of certain types, what will be the downstream effects on collection activities? How much of the additional assessments will ultimately be collected? What would be the impact on appeals or customer service? The problem space gets large, but those are interesting questions to me. Okay, so let's move on to the paper on graph machine learning. And in this one, just to recap, the authors, actually, before I jump into that, let me just acknowledge that I was grateful to receive some input from one of my colleagues, Will Sundstrom, who is currently doing work on graph neural network modeling and offered some thoughts based on his experience here. I'll talk in a moment about some potential areas of collaboration there, but appreciate his assistance with this. So in this paper, the authors look at graph-based machine learning, and specifically they use autoencoding in graph neural networks, and they apply it to the selection of audit cases for global high wealth. And this is a very appropriate application of graph autoencoders because we're dealing with a situation where, as the authors note, there are very few audits that we can draw kind of labeled data from that we can use, for the development of supervised models. And then the second goal that the authors have, in addition to guiding the selection of audit cases, is to come up with better estimates of the tax gap associated with those non-compliant global high wealth taxpayers. And kind of a key fundamental notion of this paper is that there are signals of non-compliance embedded in these networks surrounding the global high wealth taxpayers. And if we could use the information that is in those graph networks, it would give us additional signal, additional power to identify non-compliance. So, first kind of takeaway here is this is a great application, as I said, of graph-based autoencoders to deal with a situation where we don't have enough labeled data. And the way that the authors frame the research approach and what they intend to study, it is a great way to compare the effectiveness of a graph-based neural network approach with, say, a non-graph-based neural network approach using kind of an apples-to-apples comparison based on autoencoded data. A couple topics for consideration. This, again, the approach of using a GNN augmented autoencoder against a more general autoencoder is a good way to quantify the value of the graph structure. That, to me, is a very timely area of research. There are active efforts underway at RAS to try to understand the value of graph and network data. And I think more insight on the value of that data is going to help to guide efforts and investment decisions around the construction of graph data, around the development of tools to analyze those data, and the selection of research projects as well. Another thing the authors note is that they express some concern about the loss function that they are planning to use. They note that it may not be suitable for long-term use. It may not be the only loss function that could be used because the output vector that's produced by the autoencoder, they note, would have to change over time under different applications. So one question that came up there is whether there might be other loss functions that would be more suitable for general use, like designing a loss function around the ability of the autoencoders to preserve and recreate the graph structure from the embeddings. All right, a couple areas of potential future investigation or future kind of questions about those directions. One is, as the volume of labeled data expands, either through the use of annotators or through operational audits, would the authors envision moving towards more supervised methods of analysis using labeled data, or would it be more fruitful or complementary to continue to explore more advanced graph autoencoders like variational graph autoencoders? I talked a little bit earlier about the team that is working with RAS on the application of graph neural nets to identity theft detection. I think that's a fertile area of collaboration. So would welcome the opportunity to chat with Matt about what could be kind of achieved through knowledge sharing across those projects. And this is one of the two papers where my earlier comment about human in the loop strategies, I think, directly applies. Incorporating some methods such as diversity sampling or uncertainty sampling to pick samples for human review based on perceived risk using the graph autoencoded data would be a way to perhaps amplify and accelerate the progress towards effective models here. Okay, Let's move on then to the last paper presented by Siggy Scott around the use of genetic algorithms. The premise here is that detecting these new and novel tax schemes is inherently challenging because we have no labeled data, again, no past examples to guide the development of our detection strategies, and that may create blind spots and risks of significant tax gaps until these compliance issues are discovered. And sort of part of that is the idea that if we could discover these schemes sooner, the IRS could take more immediate action to prevent or deter or at least detect and address these types of non-compliance. The authors use a very innovative method here of exploratory behavior discovery and the associated software framework for that to discover these tax schemes. The process involves first using evolutionary algorithms to kind of simulate the Darwinian evolution of tax entities given a set of rules. And then in the second step, simulate the outcomes that would result and allow those taxpayers to make decisions about whether their mutation produces a good outcome. And the authors focus on a couple specific schemes around beat abuse and around business interest expense, but this approach, I think, is highly generalizable. Really, any domain where you could define a set of entities and rules under which they operate would be fertile ground for applying this method. So a couple questions that came up in my mind. First of all, when I read the kind of title of the paper and the abstract, my first thought was that the thought of using genetic algorithms to simulate taxpayer behavior sounds a little like science fiction. So I guess the first question is it feasible to create a simulation framework that's robust enough to sort of naturally discover new types of non-compliance? And Siggy pointed out well the balancing act between the fidelity of these models and the and the complexity of these models, and can we strike a balance that produces a model that yields actionable information but is also computationally tractable? Second question is, do we have the data that is needed to run and test these sorts of simulations? If we predict that tax entities are going to engage in certain types of non-compliant behavior, do we have enough detail in the information that the IRS has available to verify that these sorts of things are happening? And then lastly, it's worth considering all of the different actions that the IRS might take using the insights that are generated through these types of simulations. Siggy talked about a key step being accelerating the design and the implementation of new exam campaigns, and that absolutely makes sense. There's a number of other things that you could envision the IRS doing with this sort of advanced information. Things like providing insights to auditors who are working compliance cases, to say we should be looking for these sorts of anomalies. Could be used to recommend areas of focus for studies like the NRP to try to gather more data about currently unknown types of non-compliance. One perhaps obvious one is it could accelerate the issuance of things like rulings and internal revenue bulletins to provide an IRS position on some of these emerging tax schemes. And then maybe even anticipate some of the consequences of new tax policy before it's implemented. That may be optimistic to think that we could do these sorts of simulations far enough in advance to do so, but it would certainly be a valuable use. So I'll conclude with just a couple potential future areas of investigation around the genetic algorithms paper. So similar to the graph neural net paper, I think this is a great area to explore human in the loop processes, and Siggy talked about this as well. A couple things that might entail would be using subject matter expert input to come up with the rules of the simulation. What are the entities and the relevant transactions, et cetera? We could use discovered cases of a certain type of fraud as starting points for a simulation, kind of provide input to the model about known fraud. And we could also provide compliance experts with case profiles for exploratory research, sort of select cases that the model identifies, that the simulation identifies to conduct some sort of exploratory audit or research. I talked a bit earlier about balancing the fidelity and the complexity of the simulation. I think that's an important area to make sure that we are at a point technologically and from a data availability standpoint where we can produce simulations that are useful but also tractable. And then I also will give the authors kudos for something that they just touched on briefly in the paper, which is the reusability of this capability and their intentional development of the capability as an extensible code base so that other users can build on the foundation that they've established using a well-defined and documented software architecture. That to me, will enable the reuse and create additional value from this capability. I look forward to seeing the results of this paper. I realize it's still underway. Again, I'll conclude just by saying really impressive set of papers. I appreciated the opportunity to offer some comments and look forward to questions from the group and from conversation with the authors. So thank you very much. And I'll turn it back to Evan.
Thanks, Mike. Yeah, and in the 11 minutes we have left, let's turn it over to some Q&A and have the presenters perhaps address some of the comments from that Mike made or other questions in the Q&A box. Let's start with Matt Olson. Matt, do you want to take a stab at some of Mike's comments?
Sure. Although I have to admit, I didn't write Mike's down. I picked up Mary Helen's out of the chat. But Mike, I have to agree with most of everything you said about opportunities for collaboration. Every question you raised, I think, is a viable open research question. Just to emphasize again, this space is. That is because I didn't have my camera cover up. But to reiterate what Mike said, this is a wide open space. Every question you raised is indeed a viable research path. We're probably not going to hit most of those in this summer. We're focused on just bringing up the workflow and trying to recreate the node information. But yes, we'd love to collaborate, and you raised good points. I mean, other than well done.
All right, and any word about the Q&A question in the Q&A box about pilots or testing of your approach?
Mary Helen's absolutely right. That's the next step. I think the only point that I was wanting to emphasize is that our work right now is nascent to the point that interaction with examiners remains a precious commodity, and I don't want to be stomping around the service saying we need help when we can be doing more homework at the outset. And that's really the only point I was trying to raise. But again, Mary Helen was obviously spot on.
Gotcha. Okay. And then let's go to Siggy. Siggy, do you want to take some of the comments that Mike made or the comment in the Q&A from Mary Helen?
Yeah, Mike, I really appreciate the points you made. A lot of them mirror where, our own healthy insecurities about where the next phase of the research fog needs to get cleared, right? So I liked your point about taking known cases of fraud as a starting point, because I think any simulation development process, well, any research process at all, you take the next visible step and you try and iterate on from the simple to the complex, right? And to me, that means taking case by case. You're right. Can simulation be agile enough and expressive enough to model the economy with just the right level of detail that you can tell what the chess game is, right? Clear that fog away. that's a very speculative hypothesis, and clearly it's going to take a lot of experts in the room and a lot of domain-specific simulations and stuff if this is going to pan out into that kind of capability. But yeah, my fall reading is going to be to find as many documented cases of abuse and fraud as I can, and go learn up and see, treat it like machine learning. Which of these instances does our current framework have a chance of covering? Which of them are going to throw a wrench in the engine and say, oh, you're barking up the wrong tree if you want to be able to find this, this kind of aspect of the game, or things like that. I also appreciated your point about how there are different ways that a simulation like this, the insights that come out of it, could generate value. And we've been thinking about like kind of the two ends of the continuum you proposed of, there's, help the examiners straight up in their daily work, and on the opposite end, can we help policymakers? But I really like that you laid out several options in between that we could use, knowledge transfer from simulated realities into human experts to work to understand the things on the ground. Thank you very much.
And I know you mentioned a little bit about reaching out to examiners to take a look at some of your findings. In terms of where you're at in the kind of piloting or testing of your approaches, can you speak to that a little bit?
Sure. Yeah. So we're certainly at a kind of a low readiness level, in the sense of we don't know how this will connect to an audit campaign yet. Mike's point about you learn something in simulation, but do you even have the data that you need on the reporting side to connect the dots? Maybe not in some cases, but we have a really healthy collaboration with groups of SMEs that are experts both in the BEAT space and the 163J space, which is the business interest side that I didn't talk about, that we are able to meet regularly with them. They've been very generous with their time, and it's allowed us to avoid dialectical faux pas, as we got a bunch of engineers that are coming through trying to stomp and break things, shake things up, so it's been really great. And I feel like we have a good balance there of taking just enough time to learn each other's language and get feedback when we're like, we don't understand this part of the space. What's your experience? What inquiries have you received? While also not, kind of to Matt's point, of just coming to people and saying, hey, we're trying to figure this out. Could you spend 8 more hours with me telling me about what you do every day? Things like that. But no pilot projects per se at this point, because we're, I think, earlier in this conception, because it's a bit of a radical high risk, high reward kind of research idea.
Gotcha. Thanks. And let's turn it back to Alan now. Alan, do you want to try to take a stab at any of the comments that Mike had?
Yeah, Mike, I appreciate the comments. In general, I agree with everything you said, but it actually reminded me that maybe I should have mentioned in my presentation that this behavioral kind of stuff is almost certainly going to have a lot of dynamics associated with it over time. And we certainly aren't going to want to put some estimates in and believe that they're going to be constants of the universe indefinitely. We're going to need to keep updating them as the IRS changes its allocation based on things like this. That may in and of itself cause changes in behavior across categories. We need to stay on top of that and make sure our estimates are the best we can come up with at the moment, and always evolving. That was a great idea. I should have said that.
Go ahead, Mike.
I was just going to ask, I don't know, at least I can't think off the top of my head of seeing anybody take a stab at estimates of the general indirect effect. Is there any literature that attempts to quantify that? I don't even have a good intuition about whether it would be substantially larger than or smaller than the direct.
Yeah, well, there have been a few. In fact, I've dabbled in that myself. But as you can imagine, methodologies and data are it's a tough problem. And a lot of the problem with the general effect particularly is if you're focusing on something like an audit rate, what is the impact of the audit rate? Well, that's endogenous. And that just introduces another whole layer of complication to the estimation. So there have been some ways to account for things like that and various creative uses of data, but I think it's fair to say that the tax research community is in the very early stages of thinking through this. And we're among that. We're continuing to pursue the question.
All right. We're pretty close to time, so I think I didn't see any other questions in the Q&A box or in the chat. So I think we can, at this point, turn it over to Robert McClellan for the next session.
All right. Thanks a lot. I want to welcome people to the fourth and final session for today, titled, as you can see, Why Do Taxpayers Comply? We have 3 papers. The first paper is by Mark Payne from the Office of Research, Applied Analytics and Statistics. And his paper is To File or Not to File, What Matters Most? Oh, okay. My mistake, I didn't realize my video wasn't on. Okay, so in any case, the first paper is Mark Payne presenting To File or Not to File, What Matters Most. The second paper is by Jess Grana from the MITRE Corporation. She'll be presenting Economic Influencers of Total Enforcement Revenue Collected and Operational Implications. Final paper is by Brian Galley from the Georgetown University Law Center, and he'll be presenting Non-Monetary Sanctions as Tax Enforcement Tools, Evaluating California's Top 500 Program. The discussant for today will be Alexander Yuskavage from the Office of Tax Analysis in the Treasury Department. And so without further ado, Mark.
Yeah, thanks, Robert. Thanks for the introduction. Yeah, this research is being done in collaboration with Brian Erard, Tom Hertz, Pat Langeteague, and Alan Plumley. And it's sort of definitely a work in progress. We just got the data released by the review board at Census just very recently. So we're kind of just digesting some of the results ourselves, I guess. Anyway, I have to give the disclaimer that the views expressed here are the views of the authors and not the IRS or the Census Bureau. And the paper basically examines the drivers of non-filing. So basically tries to look at, what are the factors that lead some taxpayers to choose not to file a tax return even when they're required to do so. Not an easy question to answer, but we kind of have, studied some factors that may affect this outcome. Let's see. Okay, so well, how does the IRS define non-filing? Well, the IRS defines non-filing as failing to file a tax return when it's required, and also failing to file it, of course, on time. And a return is required if the gross income exceeds the threshold for a particular filing status. And there are some additional complications, but we'll just leave it at that for now. But also if net income from self-employment is greater than $433. And a tax return is on time if it's filed by the filing deadline, as it potentially can be legally extended or extended by disasters and things like that. But basically to be, you're a non-filer if you don't file a return at all, or if you file it late and it was required. And basically the non-filing tax gap accounts for around 9% of the total individual income tax gap. So why are we doing this? Why are we studying the drivers of non-filing? Well, one is it may suggest some interventions to limit non-filing, or it may suggest some tax law changes that also might help in that direction. And why is it hard to study? Kind of for similar reasons, I guess, that it's difficult to pre-populate returns. If you don't have well, especially for non-filers, right? Because if you don't have a tax return, you don't know who's married to who, what the filing status should be, whether the people are dependents, and also whether, especially that you don't know about income that's not reported well on third-party information documents. But census also data is kind of limited in other ways, or in that you can't really identify the fact of filing on the census data. You need the IRS data to do that. But also, we know that a lot of different income types are underreported in the census data. So a prior approach that where we attempted to overcome some of these data limitations was to look at two different samples and kind of combine them, for analytical purposes. And one of them was a sample of 1040 data from, basically the IRS administrative data. And the second one was a sample from CPS ASEC that included the entire population, both filers and non-filers. So in one, we basically had required filers, and in the other data set, we had the whole population, both filers and non-filers, but they were also, we estimated to be required to file. And then we we estimated a qualitative response model using a calibrated probit methodology, where in this case, you're looking at the differences between characteristics of filers versus the characteristics of the overall population of filers and non-filers in these two different data sets, instead of a traditional probit where you're comparing the differences between filers and non-filers in a single data set. And a limitation of this method is that you need, well, first of all, you can only use variables that are in both data sets. And then the other thing is that the variables should be comparably defined in the two data sets. So this kind of limited us a little bit in what variables we could choose to study. And also it does kind of push the limit potentially of the issue of whether they're comparably defined, when you're taking it from 1040 filings and also from what people are reporting on census. So now with this research, we're able to link CPS ASEC data with kind of very detailed IRS administrative data, both the 1040 data and the third-party information documents in this new environment of the 6103 kind of end data, where you have a full complement of IRS data being linked, able to be linked to census data through the PICs. So this kind of gives us, for our purposes of this research, kind of the best of both worlds, or at least maybe the best that you can hope for, at least when you're studying non-filers, which is to have kind of the demographic data from census, where now you can, with this data, you can estimate what filing threshold applies. You can put together the tax units according to what the CPS ASEC records look like. And then you can link them to kind of fairly detailed micro information on income and whether people filed or not, using this extensive kind of tax administration data. So we take advantage of the panel structure in CPS ASEC to put together 3 pairs of years. We look at 2014-15, 15-16, and 16-17. And it's an advantage to be able to look at these 2 years, because now we can kind of determine or estimate at least the requirement to file in 2 consecutive years. And also we can look at kind of comparably measured variables in the 2 years. So we can look at how changes in those variables might also be affecting someone's willingness to file a tax return. So how do we put together the data set? Well, we have to create weights. So we end up with all of these matched data that are CPS ASEC records that we find that meet the criteria, and then they match to the IRS data. So they have to have those personal identifiers so we can match them. And then we develop these inverse probability weights using a probate regression. And included in this probate, we look at decile positions of income, from third-party information returns, geographic region, age groups, and current and prior year kind of filing behavior. And then we combine these person-level records into tax units and assign filing status and children using the information that we're getting from the CPS-ASEC survey. And then we were able to kind of create like mock tax returns for the current year and the prior year using the income information from the third-party documents and also the CPS-ASEC information on, basically the structure of the tax unit and the number of children. And we end up then with a total of about 60,000 required tax returns. And it's important to point out that for this round of this research, we're only considering whether people exceed the gross income filing threshold for the filing status that we're estimating or them to have. And we're not considering the self-employment threshold. So this is sort of a smaller sample of those that are potentially required, to file a tax return. But at least we're kind of sure that, well, we're not sure, but we have a pretty good idea that we think that these people are required, based on the income we see on third-party documents. So then the other tables, basically how we kind of decide to divide up the analysis. Because of which we'll see in the next slide, the kind of persistence of filing behavior from one year to the next. We thought that it would be valuable to separate the analysis between those who did timely file in the prior year versus those who did not timely file in the prior year, because otherwise the effect of those kind of dummy variables might overwhelm the effect of the other variables that you're trying to look at. So it just is cleaner to kind of separate out those two groups. And then we also look at a high income group of those who, well, high income kind of in quotes, they have gross income over $100,000. And partly because we think it's kind of curious, just, why do such people not file, even though it seems to be apparent that they have a filing requirement, but also because the top decile of gross income for non-filers, we estimate is responsible for about 60% of the non-filing tax gap. So they're sort of an important kind of part of non-filers that we should understand. So here's the table that I told you about. So here we can see that, of those who filed timely in the prior year, about 97% filed timely in the current year. But of those who did not file in the prior year, only about 29% file timely in the current year, and about 68% don't file at all. And if we looked at the late filers, then there's a little bit more of a mixed behavior there. Some of them end up, filing timely in the subsequent year, about 57%, but 33%, keep kind of filing late. So this graph looks at how timely filing varies as you look at different levels of gross income above the filing threshold, broken down by whether they filed timely in the prior year or did not file timely in the prior year. And you can see from the blue line that for those who filed timely in the prior year, there's a gradual increase in the likelihood of filing as as income increases, which is sort of what you'd expect. It starts at a fairly high level to begin with, 94%, and then goes up to 97%. But again, this is kind of an overestimate because we're only looking at the gross income filing requirement. And there's a fair number of self-employed people who they may be the ones who are most likely to not be filing, and we may not be capturing them completely here. But then when you look at the not timely group, you can see that, as we saw before, they're much less likely to file in the current year. But even when you look at the high income deciles, they're still very unlikely, or they only get up to about 50% likelihood of filing. So, so anyway, that obviously that, prior filing behavior matters a lot, it seems. Okay, now this kind of breaks down filing by whether the taxpayers have a balance, or we estimate them to have a balance due, or whether they would be owed a refund. And here you can see that the ones that have a balance due are less likely to timely file, and those who have a refund are more likely to file. And as the amounts of these balance due and refunds increase, then you also have a greater likelihood of timely filing. And this is probably because the amount of balance due or refunds is correlated with income, which we just saw is also correlated with the likelihood of filing. But we kind of consider in our theoretical model that the choice of how much prepayments to make is kind of part of the filing decision. It's just sort of an earlier stage of filing. So we don't explicitly include this, in our models because they're somewhat endogenous. So, as I said, we end up estimating these logistic regression models for those 3 different subsamples. So here are the results, just some of the results, I guess. And so in all these cases, we're predicting timely filing in the current year. We do have, in some cases, in this one, it's all dark blue, and that indicates significance at the 1% level, and the lighter blue in the subsequent slides indicates significance at the 5% level. So here for the timely filed in the prior year, we find that timely filing is less likely for those who enter into the pooled sample from tax year 2016, which, we're not sure exactly about that, if that's just kind of sampling variation or something going on in 2016. We don't think so. But anyway, that's why we include those years in the pooled sample as a control variable there. And then we also find that when gross income is near the filing threshold, people are less likely to file. It sort of goes down monotonically. It increases monotonically the likelihood of filing as gross income increases, as we saw in the graph. And the largest amount of income, if it comes from sources other than wages, then you're less likely to file. If the number of children in the household goes down from the prior year, then you're less likely to file. And also if you were unemployed part of the current year, which is basically just measured by whether you received unemployment compensation of any amount, during the current year. And then timely filing is more likely for those who are married or single females compared to single males, and those who are residents of the Mid-Atlantic region, especially compared to the South Atlantic region, which was the reference category. And also you're more likely to file if we estimate that you were eligible for a larger amount of refundable credits, more than 0, and maybe, as the amount goes up, you have a greater likelihood of filing. Okay, now this is looking at those who were not timely in the prior year. So now we can include an indicator for whether people filed late in the prior year, and then the reference category is they didn't file at all. So if you were a late filer in the prior year, you're more likely to file. Again, if you were married, you're more likely to file. And also if you have larger amounts of refundable credits, you're more likely to file. You're less likely to file if you were required in the prior year, which basically means that if you were required in the prior year and you didn't file, then you were being non-compliant. So if you're non-compliant in the prior year, you're more likely to be non-compliant in the current year. So that's why that variable seems to be significant as well. And this one's kind of curious, that if you have qualifying children, you're less likely to file after we control for the amount of refundable credits that we estimate the taxpayers to be eligible for. So we're not exactly sure why this effect would be negative. And then also, if you have gross income within the first decile above the filing threshold, you're less likely to file. And if a larger share of your income comes from sources other than wages, you're less likely to file. that one's kind of consistent across the groups, that is one of the factors driving non-filing if the main source of your income is not wages. And then now for the high income group, timely filing is more likely for those who were timely in the prior year and late in the prior year, but of course it's stronger if you file timely in the prior year. And for those who had 2 children, we don't understand that one exactly either, why it would just be for 2 children. And so time filing is less likely again if you have income from sources other than wages, if you got divorced or lost a spouse during the year, or if you were unemployed for part of the current year. So that's kind of where we are now. We didn't have a lot of time to, pursue a lot of different angles on the data. We had to kind of get something out. It took fairly long to get things out of census as well. So anyway, now we hopefully have a little more time to get into this. And we'd like to expand the number of years that we are able to analyze. So then we can maybe look at the effect of policy changes and tax law changes. Also, we can maybe look at drivers of late filing. There's relatively few late filers, so we probably need more data to look at that specifically. And then we'd also look at other potential drivers of filing or non-filing, including like changes in income amounts and sources. We also would now like to expand to consider the population of those who are required also by self-employment income, maybe just including the income that you see on 1099 miscellaneous. And then another kind of side project not using this data would be to see what we can do with IRS administrative data alone and kind of compare the results that we get when we are using the linked data versus what we get in the IRS administrative data, but then adding IRS enforcement as another variable to see what impact that has on filing behavior. So anyway, yeah, thank you. And now I guess I'm handing it over to Jess. Thank you.
Great, thank you, Mark. Okay, let me get back to the first slide here. Okay, good afternoon, everyone. My name is Jess Grana. I'm an economist with the MITRE Corporation, and I'll be presenting joint work with my MITRE colleagues, Lucia Leike and Sam Schmitz, as well as Ron Hodge of IRS. So today I'll be talking about the economic influencers of enforcement revenue and the operational implications. So our core research question with this project is, can we incorporate external conditions into IRS resource planning? So what we mean by that is when you look at how the IRS allocates resources, it considers the revenue per case for each activity. And that revenue per case is typically derived from historical data. So we look at the past few years of average revenue, take a simple average, and that's sort of your expectation moving forward. So those revenue parameters are fed into an optimizer to allocate resources in order to maximize revenue. So the problem with this approach is that the historical averages may not reflect the future. And by the time the staffing plan hits the ground and folks start carrying out the enforcement activity, we might be in a different state of the world. And so those historical revenue parameters may not apply to the future. So what that could do is it could lead to suboptimal allocation of resources. All right, so what we do in this study is we try to replace those historically derived revenue parameters with a forecasted one. So we do this by trying to incorporate external information such as economic indicators, different variables capturing the taxpayer population, as well as variables capturing IRS resources. So these, what we call influencers, are fed into a model to forecast revenue. And then those forecasted revenues can be used in an optimizer to allocate resources more effectively. All right, so that's our core research question. When we thought about it, this really broke down to two different approaches. First is trying to understand conceptually, how does the economy affect enforcement revenue? So on the left, we have first research question, which is what are the high level drivers of TERC? TERC is total enforcement revenue collected. So the idea behind this approach is to understand at a macro level, if you look at enforcement revenue from an aggregate sense, how is the economy affecting it? How are IRS resources affecting enforcement revenue? How is a changing taxpayer population affecting it? So this research question is very much aimed at trying to understand what's going on conceptually. Now that's great, but we also want to look at how this would affect IRS operations. So that leads to the second research question, which is how can we allocate resources based on forecasted tax revenue? And to do this, we really need to break it down to a more granular level. So instead of an aggregate level, we're looking at forecasting revenue per case at the compliance step level. And we'll get into that a little bit more. But basically, we look at different enforcement activities and we try to forecast revenue for each activity. And with those forecast revenue parameters, we update resource allocation to generate a more optimal staffing allocation. So that's really the punchline of this research, and I'll be trying to get to that at the end. So the second model is what we're calling the micro model. All right, so a bit more about the macro model, trying to understand the drivers at a high level. Our outcome variables are TERC, total enforcement revenue collected, broken out into four subcategories. So looking at enforcement revenue for exam, for appeals, for collection, and for information returns processing or IRP. So when you look at these four components of TERC over time, there are seasonal fluctuations. There are also some long-term trends that we do see. So the question is, what's going on here? Can we create a proof of concept model to try to draw some associations between different influencers and these outcomes, as well as use that model to forecast forward? So when we say what the influences are, we're talking about economic drivers that affect total tax. You can think about, what's going on in the economy affects income and therefore total tax. Of course, IRS resources is a big piece of it that's gotten a lot of attention recently. So we want to think about how that affects enforcement capacity and therefore through that channel affects enforcement revenue. And also we can think about taxpayer characteristics as affecting compliance. Is the taxpayer population changing in a way that we're seeing, more folks in a position where they're able to be non-compliant. All right, so for this proof of concept model, we try to pull influencers that capture the economic indicators, IRS resources, and taxpayer attributes. So this is just a sample of what we've looked at. We do want to, in future research, think about including other ones as well. But for this initial set, we're looking at things like personal bankruptcies, business bankruptcies, unemployment, NASDAQ, other, your fairly standard set of economic indicators. And for the IRS resources, we are looking at the number of FTE for different IRS activities, whether that's exams and collections, investigations, even things like pre-filing taxpayer assistance and education. We think that that could affect compliance if there are more resources dedicated to that activity. So these set of influencers, conceptually, we think that they can affect total tax, they can affect the voluntary compliance rate, as well as enforced and late payments. So in future work, when we go to extend these influencers, we want to think about variables that relate to total tax compliance and the ability of the IRS to enforce compliance. Okay, in the interest of time, I'm not going to go into too much detail on the results, but I'm going to present some key takeaways for the macro model. I do want to get to the punchline, which is the resource allocation piece. So a few things that we learned from this exercise is that in this model to forecast TERC components, you have to think about the time lags of the influencer variables. There is a lag between when the income is earned versus when the return is filed versus when the enforcement action is taken. And so when we think about the relationship between the economy and enforcement revenue, there is that lag you have to consider. You also have to consider month and year trends in addition to your influencer variables. Now we talked about those 4 components of TURC: appeals, collection, exam, and IRP. They're very different activities. They deal with different parts of the taxpayer population. It takes different time to resolve. So then obviously we want to have different model specifications for each component. So one thing as an economist, I'm always interested in causation. What we found was that with this model, the causal stories are difficult to tell. Obviously, IRS resources play a huge part in the ability of the IRS to collect enforcement revenue. But other things matter as well. Things like bankruptcies, CPI came up as important variables in our model. However, it is difficult to draw a pure causal relationship in these stories because you have to deal with econometric issues. And I mentioned earlier the selection of time lags matter. So when we go to improve upon the predictive power of these models, we're going to want to think about playing around with those lags a bit more. Okay, so the macro model was a high-level proof of concept model to understand how can you pull together macro indicators to draw their association with enforcement revenue. So we're moving on now to the micro model. Here we're trying to understand and forecast enforcement revenue at a granular level, a level that's fine enough to be able to be incorporated into resource allocation models. So we have 2 econometric models that we use for this piece of the project. The first is when you look at a sample of taxpayers that are sitting in the compliance chain. We have a first question, which is which taxpayers advance to the next step. So for our proof of concept model, we looked at taxpayers that are sitting in correspondence exam. So they've been issued a correspondence exam. And we're trying to predict where do they end up after this. So we looked at the automated collection system and we looked at field collection. And then the third outcome being basically all else. So there's 3 outcomes that they can end up in. And what you see here is a graph summarizing by year, just a 10% random sample of correspondence audits, and then their subsequent outcome. So you'll see, you have very few of them in the blue that end up in field collection. That's a very, small activity, typically dealing with complex returns. Then you have in the green, the folks who go from correspondence exam to automated collection system. And then the pink is everything else. So we simplified the outcomes a bit for the purposes of the model. All right, so the multinomial logit tells us, or tries to tell us, where the taxpayer ends up next. The second portion of this model is, once they end up in that next step, how much revenue can we expect from them? So the graph here shows of the folks who ended up in the automated collection system, ACS, how much revenue do we see? How much amount do they pay? And in the pink, you'll see that some portion of those taxpayers paid nothing, and some of them paid something. So that's a darker purple. And so because a fairly significant portion of the taxpayers end up paying nothing, we ended up dealing with this issue by using a zero-inflated model that counts for those excess zeros of non-payment. So the zero-inflated model is what we use to predict once they end up in a particular compliance step, how much revenue can we expect to see from them in that step? All right, once again, I'm not going to go into too much detail to get to the punchline, but what we found with this micro model is that there are certain tax characteristics that are associated with increased probability of progression to a particular step. So things that are associated with a greater probability of progressing to ACS is using a preparer. Then there are things negatively associated with progression. So for ACS, child tax credit and rents and royalties loss, those are negatively associated with progression. We also found there are things that are increase your probability of payment. So the zero-inflated model models separately the probability of you paying something versus nothing. And then the amount paid as a separate procedure from that first step. So the things that increases your probability of payment are things like for ACS, having higher child tax credit, having prepare assistance. If you have higher total tax, that's associated with a lower probability of payment. And so those are a couple of a sample of results. And then the last piece is what increases the amount paid in that step. So we also have some associations we found there as well. So these are just preliminary results from that proof of concept model. Okay, so once we put this together and get a forecasted revenue per case, this is how it all comes together. So what we do is we get historical data on taxpayer characteristics and how they progress through the compliance chain. We build a model of taxpayer progression using historical data. Then we pool the taxpayers that are currently sitting in correspondence exam. And so the time of this research, we're looking at 2019. We know where they sit currently, but we don't know where they're going to progress. So we apply that model of taxpayer progression to the 2019 cohort to get the predicted progression for that 2019 cohort. So that's the first step. So then the second model here is that zero-inflated model, trying to predict what is the amount paid once they're in that step. So once again, we train this model on historical data. And then we feed in the taxpayers predicted to end up in that step in order to get their predicted revenue. So this is really sort of an interdependent model where first we predict progression into ACS or into fuel collection. And then we take that second model to say, okay, once you end up in that step, what can we expect to see from you in terms of revenue? So this green box right here is what we're going to use as our forecasted revenue per case in the resource allocation. Okay, now to the punchline. So a little bit of background on the resource allocation model we're using here. So we're using something called the program assessment model. And this was developed by MITRE to help SBSE allocate resources across their enforcement activities. Essentially what PAM does is it maximizes total revenue across the system subject to certain operational constraints like level of service. And so the reason we need this model is because there are a lot of interdependencies in the compliance process where things upstream affect things downstream. And so PAM is essentially a linear optimizer that accounts for those interdependencies. All right, so PAM takes as an input, one of the inputs is revenue per case. And that's what you see here. This is just an illustrative design here, where in each step of the compliance process, you have these parameters X, Y, Z that represent what is the expected revenue per case for each step. So essentially average revenue. So what we do is we swap out these X, Y, Z parameters from, the status quo is using just historical averages. So we just get rid of those and we plug in our forecasted revenue parameters. Great. So in order to illustrate, give a notional illustration of, what is the value of this activity? Why should we do this? This is what we're going to do. We're going to first take the PAM optimizer. We're going to feed in the status quo approach, which is just the old average revenue files. And then PAM will give us some optimal workforce allocation under those old revenue assumptions. Now, the second step is what we're going to do is going to go back and switch out the revenue file with the new one. So these are the forecasted values of what we think the new state of the world will be. So that will be fed to the PAM optimizer to get another workforce allocation, but this will be allocated under the future revenue file. So what we'll do is we'll calculate total enforcement revenue collected using the old approach. So the old approach is essentially some allocation that's based on those old revenue assumptions. However, if we're in, the future, we're now in a new state of the world where a different set of revenue applies, then we're going to multiply the workforce allocation by this revenue file to get total revenue. And this total revenue is going to be suboptimal by definition because that old allocation was generated under a different set of revenue assumptions, which is the old one. The final step of this is that we're going to take that new workforce allocation that was generated under the new file, the forecasted one, and multiply that by the new state of the world, the average revenue file that was forecasted, and then we'll get a new total revenue that's the truly optimal one for the state of the world that we're in now. So to show the value of taking this approach, what you can do is you can just take that total revenue that's generated under box 4, subtract from it the total revenue generated under box 3 to get the difference in revenue using the two approaches. So what do we find? So for this proof of concept model, we just looked at 2 steps in the compliance chain, ACS and field collection. So here is the old revenue parameter, $603 and then $1,300. The forecasted ones aren't that different from the old ones. So what our models are telling us is that the forecasted value of average revenue isn't going to change that much based on just the past few years. And so because the parameters didn't change that much, the allocations did not change that much either. And so the difference in revenue is small. However, this is just in this case. And so we wanted to see what happens when we do a sensitivity analysis, where we went through all the revenue parameters, we changed them by 50% up and down, and looked at what does that mean for resource allocation and what does that mean for revenue. So we pulled some of the compliance steps with the greatest impact on revenue, and we toggled the revenue parameters and looked at what does that mean for resource allocation and difference in revenue. And so for some of these revenue parameters, you do see quite a significant change. All right, finally, just want to wrap up. The major contribution of this work is to find ways to incorporate external conditions into our resource allocation planning. These are proof of concept models. We recognize there is a lot of room for doing additional work, such as adding more influencer variables, using a different model specification, as well as replicating this to other compliance steps to get this fully operational. All right, and with that, I'm going to wrap up and hand it over to Ryan Galley.
Thanks, Jess. Okay, I'm the last paper of the day, so everyone's really tired. Take a second to stand up and stretch at your desk. Have a big yawn and get that blood flowing. Okay, this is joint work with Chad Andreadis and Alan Prohofsky at California Franchise Tax Board, and with Paul Organ, who's about to start at OTA. And we're going to be talking about non-monetary sanctions, things that are other than fines. And we're going to study that in the context of California's Top 500 program, which is a program about shame. It is a program in which California posts the names of its largest tax debtors on the internet. And I have to warn you, of course, that everything you're about to hear, it does not represent the views of any of the institutions I just mentioned or that you saw on the slide, but just the individual views of the authors. Why are we interested in this question other than that, shame is inherently interesting? Well, it's because collection is an important part of the tax gap, which I don't need to tell anyone who's still on this call, it is an important policy question. So maybe a quarter of the tax gap by some estimates derives from tax liabilities that are assessed but that weren't paid. And in California, by the most recent estimate, that would mean $4 to $5 billion of assessed but uncollected taxes. And there's a fundamental problem, if you think about it, in designing policies to close the collections tax gap, right? The main tool that we use for the assessment tax gap, at least with respect to tax evasion, is typically fines. We do jail some people, but usually what we do is we charge people money. But the logical problem you have is when the difficulty you have is you can't extract money from people, threatening to charge them yet more money is unlikely to be effective. So you have a menu of potential non-monetary sanctions that you might consider instead. And a popular option around the world and in a number of US states are these so-called name and shame lists. These are internet listings typically of taxpayers who are especially non-compliant, or in India, unusually they have a list of taxpayers who are unusually compliant. And you might also consider other options like passport or license suspension. Of course, the United States has passport suspension, and the program that we study includes license suspension as part of this overall sanction. So the California Top 500 program, how does it work? Every 6 months, California compiles a list of its 500 largest tax debtors, both humans and business entities, and it posts them on the web. Before that list posts, though, California is going to warn the people and entities who might be posted of the existence of this program and of their specific danger of being on the list. So we work with California to gather administrative data on the people who might be subject to this sanction and the people who ultimately do receive the warning letters. What does the list look like? Here's a recent list from 2020. These are the biggest debtors that cycle. So you see the debts can range as high as in the $5 million range. The individuals' names, and then if they're married, the name of their spouse, if they're on the web, and also the town that they live in, and it'll also indicate their potential professional licenses that might be suspended by the state. If you skim down to the bottom of the list, you see that the balances typically at the 500th position are in this range of between $150,000 and $210,000. So the life cycle of the list looks something like this. 6 months or so before each list gets started, FTB compiles a list of everyone who could conceivably be published. Statutorily, you can only be published if you have a debt of at least $100,000. So we start with a list of everyone who has at least $100,000 in debts to the state. These are liened debts, debts that have already been subject to attachment. And that's about 6,000 humans. And then the statute also says there are a lot of other conditions required for you to be posted. So you can't be shamed if you're bankrupt. You can't be shamed if paying would impose substantial financial hardship. And you can't be shamed if you are already in an agreement to make periodic payments and installment agreement with the state, among other conditions. So the staff spends a month screening that list of 6,000 down to the 3,000 or so who they think are eligible to be posted. And at that point, they send what we call the pre-letter. The pre-letter simply says this program exists. You have a balance of more than 100,000. If you turn out to be one of the 500 biggest, you'll get another letter warning you that we're going to post you on the internet if you don't comply. I'm not going to tell you about the impacts of the pre-letter. We do study them. We have some data on balances, on households that have balances under 100,000, but we think there might be some gaps in that data. So our analysis of the effects of the pre-letter is a little bit incomplete. But I'm happy to talk about that if you're interested in our question time. Over the 4 months following the pre-letter, FTB works to further refine and rank the list. And they ultimately produce a list of the 500 statutorily eligible taxpayers with the highest balances. And then they send a letter they call the official letter. And the official letter says, you're in the top 500. We're going to post your name and address in 2 months if you don't comply. In the 2 months following, some taxpayers respond either by paying, entering into an installment agreement, or otherwise establishing their ineligibility. And so they get off the list. And California does not replace those individuals. And so 2 months later, when the list posts, there are usually only about 400 taxpayers on that list. About 300 of them are individuals. So it gives you an initial sense that the official letter probably is somewhat effective because the list goes from 400 to 300 in just 2 months. Then depends on the licensing authority, but from 1 to 3 months after that list post, there's also a notification of potential license suspension. Again, I won't show you, but we do have some analysis of whether there are any incremental effects of publication or license suspension. So overall, our focus, is on these latter stages, and I'm just going to show you the first of those, the effects of the official letter. Here's what the official letter looks like. We didn't have an opportunity to kind of experiment with or modify this letter at all. We're only looking at historical data. So you see it's quite a dense block of text, but there are a few key items on here that we've highlighted in red. They're not in red in the letter that goes out, right? It says you're going to be posted on the internet and you might have your license suspended. All right. So what we have available to study is historical data on every balance of every taxpayer who had a balance of at least $75,000, we think. And we're sure we have all that data for everyone with a balance of at least $100,000. We're going to have to study that between 2013 and 2017. The list did exist before 2013, but it only had 250 people on it. So this covers 10 cycles. The list post in April and October. And we also have daily data on everyone's payments and what administrative status they're in. So we can observe the moment when they go from an eligible to be posted status to an ineligible status. And we're going to be able to link because we have individual California tax return data for all of the households who appeared on the list at this time with balances of $100,000 or more. We're going to link all of these outcomes to data we can observe on the tax return of those households that filed. And actually a large fraction, more than a third of the households that are in this data set were not tax filers during the period that we observed. And that's notable as well. So we're going to use your propensity to file at all as one of the kind of predictors for your response to this treatment. All right. There are a few potential ways you could imagine to examine the effects of the list, right? One natural one would be to do a kind of RDD at the 500th place to see, what's the difference of being 499th versus 501st. Similarly, we could, and we do, use the variation in the amount of debt that owed by the 500th position to say, well, $200,000 of debts, some cycles you would get a letter, some cycles you won't. And so it's sort of random whether you're treated, if you're within that range of being close to the bottom of the list. The problem with both of those approaches, and we do look at them for robustness purposes, is that they're only to tell us information about responsiveness in that kind of very bottom of the list range. And the difficulty is that for policy purposes, that group is not interesting, or they're not as interesting at least, because most of the debts are far above them on the list. The mean debt in our sample is about $859,000. And so the vast amount of repayments are going to happen outside of the range we could study with those methods. So instead, what we're going to show you are just the pretty simple difference in differences analysis of the effects of receiving the warning letter. And we're going to argue that this is pretty convincingly causal because we think it's extremely unlikely that there's any confounder that could have happened to affect the treated household in the month that they get the letter. And we further are going to screen the households we study. We're only going to look at the first time list appearances because we figure if you've been on the list a few times, you're probably inapt to respond to the 7th time that you show up. And we're also going to make sure we're comparing apples to apples, we're going to omit ineligible households. But for robustness purposes, we put those back in and we find similarly that there's no response. I'm sorry. My computer is alarming as I'm saying. We find similarly there's no response in those groups at the time of the letter. So, a confounder would have to be affecting the treatment group in the month of treatment, which we think is unlikely. And then we're going to study whether the effects are different depending on what's in your tax returns. So here's the main takeaway is the effects of the warning letter. If you focus particularly on the upper right figure, you see there's a very large effect on monthly payments among those who get the letter immediately after getting the letter. And there are also, and if you look at the bottom 2 graphs, large jumps in other what we call compliance outcomes. The propensity to enter into an installment agreement would otherwise establish that you're ineligible to get posted on the list. So it looks like the letter has large effects. There are significant pre-trends in your propensity to make payment. There's an above trend jump, but we don't want to make too much of that story because of the pre-trend. In a regression framework, it looks like the monthly payment amount, the mean payment amount is about $1,600. And there's about a 4% monthly increase in the aggregate compliance outcomes. If we were to limit to just, our robustness analysis, just that band that's very close to the cutoff, the effect is not as large. So if you look in the upper right here on payments, we see maybe some evidence of a response, but it's clearly not as dramatic as when we look at the full sample. So we're quite interested for purposes of doing a cost-benefit analysis of the program, not just in the monthly responses, but what's the effect over the long run of this program? How much money does it actually bring in? And we're also quite interested in kind of whether it can tell us anything about why people weren't paying, why they ended up with the large balances that they had. That's probably why we're in this panel here at the end of the day. So I have a couple of things to tell you about that. First, in terms of why didn't people pay? This is obviously a very busy figure, but I'll focus you on the far right set of graphs. Those are the effects of the four outcomes for households that have business income on their tax return, conditional on filing a return at all. And this, if you go one down, you see the payments there, and the dashed blue line are payments by letter recipients who had business income. And you see that line is way above all the other lines. So we interpret that to mean, right, that self-employed individuals were much more likely to respond to treatment than everybody else. And it's not because they're law-abiding, right? It's the opposite. Right? It's because they're the ones who had ability to pay and chose not to pay until they were threatened with this additional sanction. Whereas other households maybe didn't pay because they wouldn't have been able to pay, or because they were already as compliant as they could be, because they were subject to information reporting, let's say. So in other words, we think we've found some additional evidence, not shocking, that there's a lot of tax avoidance by self-employed individuals in California. All right, turning to the cost-benefit analysis, right? Our long-run estimate for how much money the official letter brings in over the 2 years after a household receives the letter, the point estimate's about $1,800. And we find, some incremental effect of publication and threats of license suspension, but they're small. So look, taking a cue from the recent Jurassic Park movie, we think it's important to ask not just like, can this program raise money? It does, but also should it raise money? That is, what is the social welfare effect of using shaming as a tool for raising revenue? And essentially, I put a lot of words on the slide, but the trade-off boils down to this. For households that have the ability to pay, using shaming to get them to pay is probably social welfare increasing, assuming that you're going to do something useful with public funds. But you probably will also end up posting people to the list who didn't have the ability to pay. And for them, you have a strict welfare loss, right? You have shamed them and they couldn't have changed their behavior. And so for assessing this program, we thought it was important to try to get at least a back of the envelope sense of, what are the size of those two populations and what's the best estimate we can get for what's the maximum amount of social damage we might be doing to the people who can't comply. And we use kind of the revealed preferences of compliers to infer the likely social cost, at least the ceiling on the likely social cost for the people who get posted who couldn't have complied. We put that at about $46,000 in subjective cost. And we don't have a great measure of who doesn't have an ability to pay. But what we can say is this, right? You have to have a lot of income to be on this list in the first place. And you can get off this list by showing that you're experiencing significant hardship. So we think probably there are not that many households that really lack ability to pay. Nonetheless, our data suggests households in the lower half of the HEI distribution are less likely to comply. And so, take a conservative measure, we say, okay, assume that half of our households lacked ability to pay. There are about 161 of those non-compliers in our population. So that's a social welfare cost of about $7 million. just in shaming costs, subjective shaming costs. But we also think the program overall brings in at least $10 million in direct costs, putting aside what are probably orders of magnitude larger indirect effects. So for that reason, we estimate that at the end of the day, the program has significant positive social welfare value, several $1 million a year by our most conservative estimates. And if you had more aggressive estimates, you would have a much larger number. And we have to emphasize that these are just the direct effects of the letter. There are a lot of other pieces of the program that bring in revenue, the other 6,000 people who are being contacted by FTB as part of this program. And that probably results in at least an additional order of magnitude in revenues. So to wrap up, we want to say that we find a lot of evidence that this program causes certain compliance outcomes, including payments. We think that those payments result in positive social value, but we think it's important for social planners to think about the costs as well as the benefits. And we think that this has potential implications for the use of non-monetary sanctions more generally, both on the positive revenue side, but also on the negative accidental deadweight loss side. Thanks. I now turn things over to Alex to discuss our 3 papers. Alex, you're muted.
Hi, I'm Alex Yaskavage. I'm at the Office of Tax Analysis. Nothing I say here is the view of the Office of Tax Analysis or Department of Treasury. This is just my view, reading 3 papers about why we think taxpayers comply. So these papers are covering 3 fairly different parts of tax compliance. We have one paper looking at why do people choose to file or not file at all. We have one looking at the allocation of IRS resources and how that might affect compliance. And finally, we have a paper looking at non-traditional penalties, non-financial penalties that can be imposed on non-compliers. Now, what's interesting to me is looking at these 3 papers, they not only are interesting in their own right, but they also tell us some interesting stories about ways where the traditional compliance models fall a little bit short. And specifically, I'm talking about the Allingham-Sandmo model. If you're not familiar with it, it's a tax compliance model where taxpayers know what their income is, but can choose to report a different amount to the tax authority. If nothing happens, then they get away with paying lower taxes, but if they're detected, they not only have to pay tax on their true income, but also they pay a penalty. Now, this is, I think, probably the most important model in tax compliance. Almost every paper builds off of it indirectly or directly in one way or another. And this is where we get a lot of our intuitions about how compliance works. However, all 3 of these papers find different ways to kind of subvert how we might think about different parts of the model. So first, to talk about non-compliers. So what this paper was able to do, to file or not to file, is to draw on a data set that hadn't existed before in order to look at how compliers differ, how filers differ from non-filers, people who have an obligation to file but do not file. Now, they do this by, instead of combining different data sources, instead of comparing to distributions of the population, they start with actual census data and build up from there, adding on IRS tax data. By doing this, they're able to both confirm a lot of earlier findings, but also clarify a lot of findings that were unclear in earlier studies that they disagreed on. And largely, this is the realm of demographics. And one thing I want to point out here, I don't want to undersell how important what they're doing here is for understanding demographics and compliance, is that unlike something like how we think a tax rate might affect compliance, demographics and compliance don't have a straightforward relationship. there's usually not a causal relationship in the way we usually think of it. Rather, when you're estimating the effects of a demographic, males versus females or different age groups, what you're picking up is a mix of different preferences and individual behaviors, and that mix differs according to the different groups. And so men might have more aggressive tax compliers, women might have fewer aggressive tax compliers, but we're not saying that, you know, these all men are aggressive or all females are not aggressive. Okay, I don't think that's unusual right there. But what's important is that if you're not getting the right mix, if you're not getting an accurate mix of who's in those groups, then obviously you're going to be picking up the wrong estimates there. And this is something where their study is very important, because you're starting with the actual demographic mix that exists. By using this, they're able to, I believe, come up with the best estimates compared to earlier studies of filers and non-filers in terms of the way that we think demographics affects filing. Now, how does this tie into the compliance model? So this is obviously about the stage where taxpayers are deciding what to report to the tax authority. And one common aspect of compliance models is that taxpayers are assumed to know and be able to report relatively costlessly both their true income, they know what their true income is, and to report what they choose costlessly to the IRS. That seems very unlikely to be true. We know from the fact that how many people have W-2 income and go to tax preparers that people in general are not confident about what they believe their own income to be. And if people don't know what their own income is, it seems unlikely that they're acting as pure optimizers as described by the Allingham-Sandmo model. And you can see this in some of the results that show up in the paper. For instance, the fact that people are more likely to be non-filers the closer they get to the threshold is consistent, at least, with the idea that people don't have a great idea how close to the threshold they actually are. And it's that people further away from the threshold can be more confident about it. People closer to the threshold are going to guess wrong more often. But it also shows it up in some of the estimates they get about things like unemployment. One thing that they discuss in the paper that I thought was very interesting is that unemployment is a big driver in non-compliance. And they say there are two potential reasons for this. One is that people who are unemployed are under large amounts of stress, things are very unusual for them, and so they simply cannot get around to filing. The other possibility is that the tax law around unemployment can be rather complicated, especially if you've never dealt with it before. The first is a story about, the first issue is a story about knowledge of, the first one is a pure compliance cost, where people simply do not have the resources to comply in a psychic sense. The second is where people don't understand how unemployment tax works, is a certainty issue where they do not know. In fact, they do not know that they don't know what their true income is. Moving on to the second paper. Economic influencers of total enforcement revenue collected and operational implications. So this is a paper that tries to estimate total enforcement revenue collections and also look at how taxpayers move through various stages of the collections process by bringing in outside information about the economy and about IRS resources and staffing. Now, what they're able to do here is if you go through their paper, they do a very good job of describing how complicated this process is. There are many stages, there's many decisions to be made, and it seems rather infeasible to approach this as any sort of structural model. Instead, what they do is they use a very nice reduced form approach and say that we are going to admit that we don't know how all of these variables can be interpreted. What does that mean? So on the one hand, they find that the number of full-time employees at the IRS has a positive effect on total enforcement revenue collection. That makes a lot of sense. They also find that an increase in business bankruptcies increases enforcement collections. That I have a harder time understanding why. They find that an increase in GDP leads to a decrease in collections. You can come up with stories for this, but there's no compelling, obvious answer for some of these. The claim then is that this isn't an issue if things aren't changing over time. If these relationships between what people are actually doing and what we observe in terms of GDP or bankruptcies is staying relatively stable over time, then we can still use these for forecasting. Now, this is something that plays very heavily into our idea of how people perceive their chances of being audited. So when you look at the standard compliance model, there's this probability of audit that kind of exists. It can be conditional on certain things that the auditor can observe. Maybe it depends on demographics and so on. But fundamentally, the model includes this probability of being detected for audit and gives us no guidance about where it comes from or how it's calculated. When you really start digging into it, you realize that this probability can't be the objective audit probability. Nobody knows what that is. Really what it is it's the taxpayer's perception of what their probability of being audited is. What this means, this complicates the idea of having a reduced form model where you're assuming the structures stay the same over time, because even if the actual structure of the economy is staying the same over time, the vibes might change. So anecdotally, I see a lot of people online when they're asking for tax help are told, you should contact the IRS, call their helpline, they're helpful, they'll help you figure it out. The way that people would respond to an increase in IRS staffing is very different in that type of environment than in one where people see IRS staffers as adversarial or something to be avoided. And so you have to be very careful here that you really do have an understanding of how taxpayers are taking the facts of the world around them and building them into an object that they use when they're deciding how likely their behavior is to result in audit. And then moving along, finally, I want to talk about Brian's paper, non-monetary sanctions. So this paper takes a look at penalties that are outside the realm of what's typically applied. Instead of direct penalties being applied, we're looking at either putting somebody's name on a list or revoking certain professional licenses. They find that these tools are very important. And what I particularly like about this paper is that it's able to separate the effects of the penalty from the person's perceived effects of being detected or of being punished. This is a situation where people have been on the list, they've received letters, they know what's going on. And so all that's happening now is they're being told, we're going to apply this penalty now, what are you going to do about it? And that sidesteps a lot of issues that are typically involved in, like on the previous point, understanding the psychology of how taxpayers are estimating these probabilities. Now, the third part of the Allingham-Sandmo model is the penalty that's applied to the taxpayers. And obviously, this is playing a big role here. What's different about it is that the Allingham-Sandmo model kind of assumes that there's this one uniform penalty object that can be applied to individuals who are not compliant. That almost certainly is not the case. Normally, the way you would incorporate like something like the naming and shaming into a model, you would estimate some sort of willingness to pay that the person would pay to avoid. the fact that these are people who have been resistant to fines and penalties for this long suggests your estimates would be very large, probably would not be very sensible. What's much more likely is that these are simply domain independent objects. There are some penalties that are financial and are tax-based, and then there are some penalties where you feel like a fool because your name is out on the internet. And that's something, like I said, that the standard model can't handle. It's something that we would have to think about how to incorporate it. And why might we think that these things just don't mesh and line up purely as additive objects? Well, we know that people don't even think about withholding and their April tax payment as similar things. They apparently use very different methods for how they incorporate those into their utility. And so the idea of your name showing up on a list of the internet, being able to be put into dollars easily, that's comparable to what you're paying for your income taxes. If you think that that's complicated, then you have to start looking outside of the Allingham-Sandmo model for guidance. So what we have here are 3 papers. They're all looking at compliance in different ways. They all give us different types of insight into how we can think about the standard compliance model. And I'm at 15 minutes, and I think only 12 people have left. And so I'm going to quit while I'm ahead.
All right, thanks, Alex. Appreciate those comments. And I want to remind the audience to put questions in the Q&A box, and that the slides are available online at taxpolicycenter.org. So we have a couple of questions already, both about the California Naming and Shaming Program. And the first is, how can the California Name and Shame Program not violate confidentiality of taxpayer data?
Well, it does. I mean, it does violate confidentiality by design, and that's why it has to be authorized by statute. It's only disclosing California tax data. It's not, of course, disclosing any federal debts.
Okay, and then I had was another question about shaming costs and social welfare, similar to what Alex was discussing. So suppose you could want to speculate here, or ask you to speculate. Suppose you could separate those who don't have the ability to pay into those who don't have an ability to pay because they spent their money on vacations or gambling, versus those who can't pay because they spent their money on a house or something that can be subjected to a lien. Would that, in what way do you think that would change your social welfare analysis?
Yeah. It depends on whether there are upstream effects. And so what I mean by that is, here, I'll come back on screen. The extent to which these households anticipate that they would be shamed and plan their budgets accordingly. So, you know, if you imagine that what's happening in Mary Helen's hypothetical is someone is anticipating that they're going to get a raise, they've spent that raise, then they don't get the raise and they don't have money to pay their taxes. We're not getting blood out of that stone at that point. And so we might feel better in kind of a just desserts sense in, you know, shaming that household, but we're still not getting any additional revenue. It's still pure deadweight loss. Where you would get revenue is for households later in time that now do a better job of planning their budgeting because they want to avoid the later shaming. You know, we can't get a handle on that effect with our estimates, and I'm not sure it would really happen.
I see. So I have a follow-up question. Has there been any pushback about the program? Is there is there a perception that this is the government is bullying people into paying, or I don't know, is there anything like that?
And we are working on a follow-up project to figure out if there are any taxpayer morale effects, either positive or negative. I would guess that, you know, the web traffic to this site is modest. There are occasionally news stories about the list. So I don't know how big the ultimate morale effects are, because I don't know, you know, how many people know that these programs exist.
Okay, do people have additional questions?
I had a question, a comment on our first paper. Just in
Sure.
the chat, but,
Please go ahead, proceed.
you know, one of the reasons that unemployment maybe would reduce filing is because you're relative to other forms of income, it doesn't count for the EITC earnings test. And, you know, EITC is a big driver of filing behavior for lower income households. So maybe that's another factor in addition to the ones that Alex said, which made sense to me.
So something else about the first paper that I thought was interesting, you don't mind if I jump in here, Rob, do you?
No, please.
Was how important the persistence effect was, to the point where you had to estimate them as two separate models. And I was wondering if you had any sense of what was driving that, if it was a case of some people just don't like to pay their taxes, or if it could be path dependence, where one year somebody didn't pay their taxes, and so next year they look at their old return and say, well, I didn't have to pay taxes last year, so I probably don't have to pay it this year either.
Yeah, I think we have to do a lot more digging there. I mean, we've kind of seen it in all of our work on non-filing. I think before, like because we do the measure of the voluntary filing rate, you know, so we've been looking at this kind of for a while in the tax data, just the tax data itself, and then with the non-filing tax gap, and we've kind of seen that there's a lot of repetition of non-filing, and it probably, a lot of it tends to be near, you know, kind of near the filing threshold. So there is some uncertainty probably still, especially in the tax data, about whether there is a filing requirement. But it does just seem to, you know, there also is, you know, not, well, I mean, I don't know if we should get let this out, but, you know, the enforcement is so, you know, for especially people kind of near the threshold, you know, because if you're owed a refund, you probably won't, I mean, you know, it's still illegal, but you know, you may not get a notice about that, you know, so people just kind of, you know, it's a burden to file, you know, so that's one of the variables that we tried to look at in the analysis is also bringing in, you know, what's the filing burden, you know, on a given return, because that may be a deterrent to filing and keeping people, even who might be eligible for EITC, you know, from filing, you know, for EITC. So there's a lot of stuff going on, you know, in the lower income thresholds. You know, one thing is being uncertain about your income. The other thing is, are you eligible for EITC or are you not? Some are and some aren't. And do you know you're eligible for EITC? And then do you know what your, you know, what your income is? But I thought that was a really good question, because I think I kind of have similar questions about, you know, like say, you know, it seems like we're finding that self-employment income is, as opposed to wage income, is a driver of non-filing, that these are people with self-employment income that's visible to the IRS. You know, they have a 1099 miscellaneous with non-employee compensation. Of course, like we don't know exactly what the net self-employment income is, which would be what would be taxed, you know, but if it's a, you know, a certain amount, then it's likely that some of it would be taxed. But those people seem to file less. So is it that, you know, so this kind of raises the question of how hard to push, you know, the theoretical model. Like, are some people, I mean, does it make a difference that people are having money withheld kind of automatically in the W-2 versus they have to kind of make it a conscious decision, and, you know, they have to actually act upon it, you know, to make estimated tax payments. So I think the model sort of treats those things as being the same, right? Like you're deciding, like, are you going to pay now or are you going to pay later? But for some taxpayers, it may be kind of unintentional that, you know, they end up realizing, oh my gosh, I owe a lot of money at the end of the year. And then, oh, I don't want to pay, I don't want to file my taxes because I know I owe a lot of money. So, you know, I don't know, how do you want to look at that? Like, is that part of the filing decision, or is that a separate decision that is maybe just kind of lack of information? You know, so it might still be a place where, you know, the tax authority could intervene, you know, to maybe get people so that they would be better prepared and not owe money at the end of the year, and then also not become non-filers, So anyway, I thought that point was interesting on your part.
And then I had a question for Brian, if I could ask some more questions. So I thought the business license thing was kind of interesting because it's not a transfer like a fine is, but calling it a non-financial penalty doesn't seem quite right either, because you're restricting their ability to do certain types of business. Have you given any thought to how that might affect either side? It could affect either how people are responding or how the state chooses to implement it.
Yeah. And actually, if it's a competitive industry that they're operating in, it is a transfer because their customers are going to go to somebody else, right? In a sense. So no, we haven't thought a lot about that, but it's worth saying. We don't say a lot about the license results because we only have license data for the people who actually get published, and so we can't do a real trickle difference. But you're absolutely right. It's worth thinking
Well,
that through.
yeah, in terms of transfer, I was thinking transfer to the government. So one thing that I think about is, I have no idea if it's true or not, but I remember reading somewhere that in Viking society, if somebody wronged you, it was legal to kill that person, but it was not legal to take their stuff, because this dealt with certain incentives then that you would have for just claiming, oh, that guy did me wrong, I'm gonna take all his oxen or whatever. The license thing is interesting because it is a direct financial penalty to the person it's being applied to, but the state doesn't see any revenue from it. Just something to think about.
Right. If you're really interested in that, I have a 30,000 word article about it. It's not in this book.
And then a question for Jess, just to work through my list of questions. One thing that struck me reading through your paper is that it seemed like what you were describing was something awfully close to describing how the IRS decides to do its audits and compliance. Do you think there's any concern if the IRS was drawing in information from like the NASDAQ or whatever, that people would be able to incorporate that into their own decision making, or especially when you're looking at the micro model where people are progressing from stage to stage, people are saying, oh, turns out if I change some easily changed characteristic of myself, I could reduce the chance that they think I'll be able to give them a larger payment. Is that something that came up?
That's a great point. And I think that if the algorithms were public, then that would be an issue. Just like the audit selection criteria the IRS uses, right? They're not public for a reason, because we don't want folks to know exactly how those happen. So if these models were incorporated into operations, yeah, that would be, we definitely wouldn't want to make them public. Can I quickly address some of your other comments from earlier?
Go for it.
First of all, I think you gave a great evaluation of the pros and cons of the paper. I agree that trying to build a fully causal model of how the economy affects enforcement revenue is difficult. It's probably not, the juice is probably not worth a squeeze. So ultimately, I think what you're dealing with here is a predictive issue, a problem, not a causal problem. In which case, we probably want to choose a different set of methods. Econometrics probably not the best toolkit for that. So very much echo your sentiment there. The other issue with the micro model you mentioned is, modeling progression a bit more carefully, thinking about taxpayers' perception of that. I think that there's definitely more work to be done there. Just trying to incorporate a better set of predictor variables, maybe trying to draw a little bit from IRS business rules could help improve the model. So yeah, thank you for your comments. Very, very great. I appreciate the other papers as well.
Okay, I had another question for Jess, and this was a technical question or a question just for information. So in your model, as people proceed through the correspondence exam to the collections are due or money's due, and then you have this Logit model where people can end up in the automated collection system or in the field collection or the all else category. The all else includes people who, well, what is an all else? Is it mostly people who paid or?
Balance, yeah, paid. It could be installment agreement.
Installment agreement.
Yep. Mhm.
I see. I see. Okay. And do we know something about the people who do that versus those who go through, well, between those and ACS, or more in particular between those who go to installment plan or pay versus those who go to the field, more difficult field collection?
So the all other is wrapped up into one category, so it can't, differentiate, within. But essentially, what you do is you look at how different tax characteristics affect the probability of progressing to ACS or field collection, and the baseline category is that all other category. So it's in reference to that category.
Okay. Are there any other questions? Oh, okay. Well, I think we can probably stop 1 or 2 minutes early. And if Barry Johnson is here, I'd like to introduce Barry Johnson, the Deputy Chief Data and Analytics Officer, to close us out. Barry?
Great, thanks, Robert. It's been a great day. And but as Brian noted, it's also been a long one, so I'll be really brief. First, on behalf of RAS and the IRS, I'd like to thank Eric Toder and the Urban Institute for partnering with us on this 12th annual conference and for serving as our virtual host today. The team at Urban has done an amazing job managing the technology today, creating a really engaging environment, which I know is the result of a lot of behind the scenes work for this great team. Next, I'd like to thank each of our speakers and discussants for taking time to share their work today. The presentations were all very informative and well organized, and I know that we all learned a lot. It took a great deal of time to prepare these presentations, and we really appreciate your sharing your expertise with us. I'm especially grateful for the feedback our discussants provided on the RAS work, and I assure you that the suggestions will be important in guiding the future development of our work. Thanks to our session chairs for keeping our sessions on time and managing the Q&A sessions so efficiently. And of course, we wouldn't have had any speakers without the hard work of Alan Plumley and the committee that put together such a thoughtful program. Having served on this committee a few times, I can attest that it's a significant time commitment to review all the abstracts, create cohesive sessions, and identify discussants who can both summarize the key themes of the papers for the audience and provide useful feedback to all of our authors. So thank you very much. And then finally, thanks to you, our audience, for spending part of your day with us. We appreciate your questions and your feedback. Your insights are an important component of the research process, and we appreciate how generous you've been in sharing your ideas. We do have one final ask of you, and that's that you take time to fill out the survey that Urban has provided. Your feedback on the meeting will help us to improve future programs. And so with that, I'll close the conference and hope that I see you all next year, ideally in person, as we continue our work to use data and analytics to improve tax administration. Have a great rest of your afternoon, and goodbye.